So this month in April, we're doing a series all about taxes that we encounter in estate planning. And today is the fourth and last video of the series, all about capital gains taxes. So what are capital gains taxes anyways? Well, basically, capital gains tax is a type of income tax that we encounter when we're buying and selling an asset. So I'm going to dive kind of deep today, so hold on and we'll see all about capital gains taxes. So first, I want to provide a few definitions. First is the term cost basis, which is basically the original value of an asset plus improvements. The next term is carryover basis, and that's when one property is transferred to the next property and it keeps the same cost basis. And then the third term is a step up in basis. That's an adjustment in the cost basis at the time of an inheritance when the owner dies, okay? The owner dies and the cost basis is then increased to the fair market value at the time of the owner's death. That process is called the step up in cost basis. Okay, so now we have the definitions. So how much is the capital gains tax? If something is subject to capital gains tax, what are you paying? All right, well, it's a combination of federal and state income taxes. So, and it depends on what income tax bracket you're in. So the federal tax can be up to about 20%, and the California tax can be up to about 10%. So you're looking at perhaps a 30% tax on these assets. Now, a couple years ago, in 2021, the Biden administration proposed doing away with the step up in cost basis, saying when somebody dies, the property gets a step up. And everybody freaked out. I'm telling you, we all got so scared. Well, there was never any traction in Congress. That never made it any farther than a mere proposal. And we still have the step up in cost basis. So I get asked this a lot. So I just wanted to clarify, all right, we still have the step up in cost basis, at least here in 2023. Okay, so I want to give you an example of how this works. And the simplest example might be stock, all right? So here I have a little example here. All right, so we have some stock and you buy the stock for $1. Well, that's nice. All right, and then the stock goes up to $10. It does really well, and then you sell it, all right? That difference or gain in the value of the stock is taxable. That's the 30% tax that would be imposed. And if we were to calculate how much you're paying on that, right? $9 in gain times 30%, that would be like you're paying $3 in taxes, which most people want to avoid. So that's why we're looking into these things. Now let's say somebody bought a house for $100,000. And then that house, over the years, the value increased, the fair market value up to $1 million. And then they sold the house. Well, the first $250,000, if it's their primary residence, would be a freebie. That would be forgiven. So the gain of $900,000, we would subtract $250,000 from that. So what are we at? $650,000, and you'd be paying taxes on that $650,000, a 30% tax. Let's say $200,000, not great. And also keeping in mind that in my area in Palo Alto, usually the example we see is somebody purchases it for $16,000 and it goes up to $3 million. All right, so we have a lot more gain. Now, if you're a married couple, that you get to apply that $250,000 twice. All right, so it's actually a $500,000 difference. But if we're looking at, let's say, a $3 million gain, you're still paying taxes on $2.5 million. So that explains really why people aren't selling their houses a lot of times, because it would be subject to a huge gain. Now, here's what happens. So let's say you bought that house for $100,000, it goes up to $1 million, and then the owner dies. You die, and your child inherits it and says thank you. When the child inherits it, that original cost basis of $100,000 gets a step up to $1 million. And then the child inherits it as if the child had bought it for $1 million. All right, the new cost basis is $1 million. Then the child can turn around if they want to and sell the property for $1 million, and there's no capital gains tax at all. So the step up in cost basis is very important. And the moral of the story here is it's really good to die owning assets because all of your assets get a step up in cost basis. So where do we see this in estate planning? Well, one of the things is, if you own a house and you're thinking about selling it, or giving it away to somebody else. So let's talk about that. If you sell the house, we already saw $100,000 to $1 million, $900,000 of capital gains exposure. Now, if you bought it for $100,000, it goes up to $1 million, and then you give it to your child takes the house as if the child bought it for $100,000. All right, that's the carryover basis. The child is receiving the original cost basis from you. You haven't died in the interim, so there's been no step up in cost basis. So that's one reason that I talk about on my video about transferring ownership of property. Is it a good idea? That's one reason why it's not a good idea, because you're getting the carryover in basis, not the step up in cost basis. Okay, so another place we see capital gains tax come into play is when we look at estate planning and our A-B split. So I talk about this chart. You may have seen it in prior videos, but this is the way a lot of people have drafted their trust, especially before 2012, all right? Where you see that you have the family trust, and upon the first death, it splits into 2 or 3 trusts, sub-trusts, all right? So we have the survivor's trust, we have the bypass trust, which captures all of the estate tax exemption for the deceased person. And then the deceased person's half, anything above what goes into the bypass trust goes into the Q-tip trust, all right? Now, here's the nice thing. Anything in the Q-tip trust and the survivor's trust, upon the survivor's death, gets another step up in the cost basis. So at the first death, I should mention, everything in the family trust, as long as it's community property, gets a full step up in cost basis. Yay! But then let's say the survivor lives another 20 years, as survivors often do, okay? Then anything in the survivor's trust upon the survivor's death gets a step up in cost basis. Anything in the Q-tip trust gets a step up in cost basis. But anything in the bypass trust is protected from estate taxes, but it does not get a step up in cost basis, all right? So that can be a drawback. So if you have your estate plan that's been drawn up a while ago, or if you notice that it has this split and you don't really need the split, you don't have control issues like, it's a blended family and you want to make sure that your half goes where you want, and you don't have a really large estate to make sure that that bypass trust is fully funded. If you don't have those issues, then I usually recommend simplifying your trust. And I have a video all on this called, Should I Simplify My Trust? But I did want to focus especially on that capital gains tax issue, that a lot of people are simplifying their trust because they don't like having a bypass trust that's not going to get a second step up at the survivor's death. Okay, something else that's kind of interesting and not very good is that a lot of times title companies will automatically have a married couple take title in joint tenancy. Why they do this, I don't know, because that's not good from a capital gains tax perspective. If you're holding property in joint tenancy and one person dies, they're each considered to own 50% of the property. So that one person, that half, gets a step up in the cost basis upon the first person's death. But the survivor does not get a step up on that half. So let's say in that example where it was a couple bought a house for $100,000, it goes up to $1 million, and it's held in joint tenancy, and then one spouse dies. That step up would only go up to, $550,000, not to the full $1 million, all right? So it's now established at half of the fair market value, which isn't great. So sometimes to solve that, we would bring something called a spousal property petition. So there's ways to fix this joint tenancy issue, but you should know that it's not ideal typically to hold assets in joint tenancy if you're concerned about capital gains taxes and getting that full step up if that property is your community property. Okay, so the other place that we see capital gains taxes come up a lot in estate planning is during the trust administration process. So you already know that everything gets a full step up when somebody dies. Well, we need to establish what is that fair market value at the time of their death, because we want to see, okay, all of those assets goes up to that amount, and if anything gets sold, then you don't have to pay the capital gains tax, or you only pay the taxes. Let's say, the house goes up to $1 million from that example. It starts at 100,000, goes up to $1 million, parent dies, the child inherits it, then the child holds on to it a little bit longer and then sells it for $1.2 million. So the child will need to pay capital gains taxes unless they've made it their residence, but they will need to pay the capital gains taxes on that $200,000 increase, but not on the $1 million, right? So we always need to establish what the fair market value was of all of the assets the parent owned at the time of death. So how do we do this? We get appraisals for the real property, and we also get date of death valuations for the securities and stocks and brokerage accounts, right? And we can just tell what the value is of cash by just looking at the statement and figuring out at the date of death. So this is a really important part of trust administration, so you shouldn't skip over that. In fact, I would love to direct you, now that you know a bit more about capital gains tax, a lot of this happens when you die. So I encourage you to watch my next video, what happens to my trust when I die, because we do talk about a lot about capital gains tax in that video, and I'll see you over there.